What's going on YouTube? In today's video, we're going to be talking about how much you actually need to buy a home. So whether you're a first-time home buyer for your primary residence or you're trying to buy a rental property, knowing how much you actually need to buy a home can be very intimidating, especially since most people only buy one or two houses in their entire lifetime. So in today's video, we're going to go over all the costs associated with buying a home so that you know exactly how much you need to save up before you can buy one. If you guys don't know who I am, my name is Sean and I make real estate easy. My wife and I own 34 units across the nation, and I used to be a lender for 3 years, so I'm pretty well versed in this topic. So when you typically think about how much you need to buy a home, most people only consider the down payment. So you may have heard that you only need 20% down. Then most people think that that's all they need, just the 20%. But unfortunately, that's not true. There are a lot of extra hidden costs associated with buying a home. And it's kind of like the example of when you first try to buy something at a store and you see the price for $10 and you go to the cashier and you give them a $10 bill and they say, well, your total is actually $10.90 because you have to pay for taxes. That's very similar to what's going on here. Yes, you need 20% for the down payment, but there are also hidden closing costs associated as well. So before buying a home, you need to be prepared and save enough before just going in. Because once you start the process, there are some fees that are involved that you can't get back, and we don't want you wasting money. So we'll break down these costs one by one. First one is your down payment. And that one is pretty obvious. It's going to be a percentage of your purchase price. Naturally speaking, the lower your down payment, the riskier the loan is for the lender. So the more they're going to charge you for the loan. But getting a lower down payment loan means you can get the property sooner. So the trade-off between if you want a higher rate mortgage with a larger loan amount, but get started sooner with a lower down payment, or you're okay with saving up for a higher down payment and getting a lower rate mortgage and a lower loan amount. So this is really a personal decision. And we've done it both ways, where we've had properties that we purchased with just 5% down for our primary residence. And we've also bought properties completely with cash. So it just depends on where you are financially. The second thing you have to have are your closing costs. Closing costs are costs associated with closing your deal completely. So even though when you're buying a home, you don't have to pay for the real estate agents, you still have to pay for the title and escrow fees, which are the companies that actually handle the exchange of the property and the money. Another part of the closing costs are your processing fees that you have to pay to your lender. And if you're getting a mortgage, then you're going to have to pay processing fees and origination fees to your lender. They're also going to charge you a prorated amount of your mortgage if you're closing in the middle of the month. And when you're buying a property, your lender may also ask you to pay for a survey, which can be another $600 or so. And that just determines where your property sits on the border and just to make sure that your lines are correct. Your lender will also charge you an appraisal fee because when they do their loan, they have to hire a third-party appraiser, come here and check on the value and make sure that it's correct. They want to make sure that you're not getting a loan for $1 million home when the true value of the home is only $500,000. So an appraisal will cost another $700 or so. Now, when you get your contract accepted, one of the first things that you need to send is the EMD, also known as the earnest money deposit. Earnest money deposit is going to be around 3% of the purchase price. So if you're buying a home for $300,000, then you should put in a $9,000 earnest money deposit. And you might be thinking, if I have to put down a 3% earnest money deposit now, and my down payment is 20%, does that mean that I'm ultimately going to be putting down 23% when I buy the property? And the answer is no. 3% is an earnest money deposit, but it counts towards your 20% down payment. So when you close, you'll only need to put down 17% more. The earnest money deposit is just a deposit that shows the seller that you're serious. And if you back out of the deal without a legitimate reason, then your 3% is forfeit. Now, this may not be such a big deal if your purchase price is only $300,000, but for some people who are buying $1.5 million homes in the Bay Area, that's $45,000 that they have on the line. So these people are committed to make sure that the deal closes. Now, another thing that you need to consider, but it's not mandatory, are renovation costs and maintenance costs. So when you buy a home, there's a chance that not everything will be to your liking and perfect. So there might be some small repairs that need done, or maybe you want to change the cosmetics, like you want to change the flooring or the wall colors. Just so you know, it's going to cost a few $1,000s to do these repairs. So make sure you have that saved up. And if there are some larger repairs, like needing a new HVAC system or a new roof, these can be $5,000 to $10,000. And also don't forget, when you buy a home, it usually comes empty. So if you're buying your own primary residence, you should also factor in a few $1,000s for buying furniture. So those are the actual costs associated with buying a home. Now, before we go into an actual example together, I want to talk about how much you need to be making to even qualify for a loan in the first place. For most conventional loans, they qualify you based on your credit score, your debt to income ratio, and the amount of savings that you currently have. So your credit score is an obvious one. If you have great credit, then the lenders are going to love you and give you a higher loan amount and the lowest rate possible. But if they see that you have a history of missing payments and you have a hard time of being responsible with your finances, then they may not even give you a loan in the first place. Step number one is make sure you have a good credit score before even starting the process. And if your credit score is not that great today, that's fine. Just spend the next few years improving it as much as you can. The next thing you need to have is a good debt to income ratio. What a good debt to income ratio shows is that you are not overburdened with other mandatory payments to be able to afford this home. And the way they calculate your debt to income ratio is they're going to add up all of the minimum payments from all of your debt and divide that by your gross income. So if you have any student loan debt, credit card debt, car payments, they're going to add that all up with the PITIA of the new home you're going to buy. PITIA is your monthly principal and interest payments, which is your mortgage, your taxes, your insurance, and HOA dues, if any. So you add all those debts up together, and you make that your top number, and you divide that by your gross income. If you or your spouse are married and you're getting the loan together, they're going to combine your gross income. So if you make $60,000 and your wife also makes $60,000, then that's $120,000 combined. So if you divide that by 12, that's $10,000. Most lenders want to see a debt to income ratio of 43 or below, meaning that you don't have too much debt and you can support this new loan. Some other loan programs may be as high as 50% debt to income ratio. So with this previous example, all of your debt add up together, plus your new PITA payments need to be $5,000 or less because it needs to be under 50% of $10,000. Another thing that many lenders want to see is that you have enough savings or reserve. Obviously, you need enough money to pay for the closing costs and the down payment, but many lenders also want to make sure that you have 6 months of the monthly payments in reserve somewhere in the worst case scenario that you happen to lose your job when you're closing your property. They want to make sure they don't just give someone a loan and they have no more money to actually pay the loan off. Let's do an example together. What you can do is download the worksheet I have for free in the description and follow along with me. When we look at the worksheet, first question is how much are homes in the area that we're looking in? As a simple example, I looked up a random property on Zillow. This is a home in Jacksonville, Florida, and we can see that it's selling for $320,000. Let's just write that number down on our sheet here. So we know that homes in the area are going to be around $320,000. The next question asks us how much is 20% down, so we know how much we have to save for down payment. 20% of $320,000 is $64,000. The next question is, what is 3% of your purchase price? As a very brief example, we're gonna generalize this and make this our closing cost. Now, your actual closing costs are gonna be higher or lower depending on the title and escrow company. 3% is a general rule of thumb. In this case, it's gonna be $9,600. So the next few questions are what's your mortgage, property taxes, insurance, and HOA dues. If you scroll down the listing here, you can actually see an estimated monthly cost of what everything is gonna cost. If you click into it, you can adjust some things here like 30-year program, your down payment is this much, your interest rate is this much. Obviously, change these numbers to whatever fits your needs and what seems more realistic to you. Check that the property taxes is decent and check out their home insurance to make sure that these things look right. If you add these all together, once you have these numbers down, you can fill them out on your sheet. So principal and interest is $1,688. Your mortgage, property taxes are $205. Insurance is $112. And there are no HOA fees. So if we add these all up together and multiply the expenses by 6, we'll know what our reserves numbers need to be. So this totals up to $12,030. Just all these numbers together, multiply by 6. So the total savings goal is by adding up the numbers from 2, 3, and 5. This number plus this number plus this number is how much you need to buy this home. So this adds up to $85,630. So the next part is figuring out the actual savings plan. Let's say I want to buy a home like this in 5 years. So 5 years is going to be 60 months. So then to know how much I need to save every single month, you take this number here and you divide it by this number here, and that totals to 1427. So if you divide this number by this number, you get 1427.16, which means that you need to save a little under $1,500 a month to be able to afford a home like this in 5 years. Step number 9 is that we do recommend that you automatically just put this money into a bank account before you even spend any of it. That way you know for sure you'll be ready in 5 years. So now that you know exactly how much you need to save to buy a home, and you have the sheet here that can help you create a plan on how much to save, the next thing you need to learn is how to pay off your loan faster, save tens of thousands of dollars over the lifetime of your loan. You can check out this video over here. Thanks for watching, appreciate you, and I'll see you next time. Take care.